Today, we're diving deep into a financial strategy that's built for the real world, not some perfect world spreadsheet. It's about creating a portfolio that can handle not just market crashes, but maybe more importantly, our own very human, very emotional nature.
So let's start with this idea. Think about it. We spend so much time analyzing charts, news, and markets, but what if the most unpredictable, the most dangerous variable in your whole financial life is the person staring back at you in the mirror? This entire strategy is built from the ground up to deal with that one simple fact.
All right, so here's the blueprint we're going to be taking apart today. At its heart, it's a 60-30-10 split. You've got 60% in stocks for that long-term growth, 30% in real estate for some real-world stability, and 10% in gold is your crisis insurance. But the real key, the thing that holds it all together, is that cash buffer on the side, a full 1 to 2 years of living expenses. Every single piece here has a job to do, all aimed at one thing: survival. Here's how we're going to break it all down. First, we'll get into the philosophy behind the whole thing. Then we'll build it, piece by piece. The growth engine, then the stability anchor that protects it. After that, we'll look at its unique defense system for when you actually start living off the money. And finally, we're going to put it through a brutal stress test.
First up, a plan for survival. Before we even look at a single percentage point, it's absolutely crucial to understand the thinking behind this. There are some core ideas from a few key financial thinkers that are the bedrock of this whole approach. So this isn't just a random mix of assets, right? It's a blend of powerful philosophies. From Nick Maggioli, it takes this relentless, data-driven idea to just keep buying no matter what. From Charles Ellis, it humbly accepts that trying to outsmart the market is a loser's game. So we stick with simple, low-cost index funds. And maybe most importantly, from Morgan Housel, it embraces this incredible insight. Being reasonable in a way that works with our emotions is way more powerful than trying to be perfectly, coldly rational.
Okay, let's get into the biggest part of the portfolio, the part that's really meant to build our wealth over the long haul. Section 2, the 60% growth engine.
This quote from Nick Maggioli really is the core operating principle here. The strategy is all about systematic, automated investing into US and Taiwanese index ETFs. You don't try to time the dips, you don't get scared of all-time highs, you just keep buying month in and month out and let time and compounding do all the heavy lifting for you.
So you might be asking, why the US and Taiwan? Why so specific? Well, even though we're using passive index funds, this is actually a very active and concentrated bet. It's a bet on the entire supply chain of global technology, from the American geniuses at places like Apple and NVIDIA that design the future, all the way to the manufacturing powerhouse in Taiwan, TSMC, that actually builds it. You're basically buying an index of world-changing innovation.
And this right here, this really gets to the massive tension at the heart of the growth strategy. It's a real double-edged sword. On one side, this concentration in what's called the Silicon Shield gives you this incredible economic moat that drives amazing growth. But on the other side, it's a huge geopolitical risk. It's a fragile choke point. And that single massive risk is precisely why the other 40% of the portfolio isn't just nice to have, it's absolutely essential.
Okay, on to Section 3, the 40% stability anchor. So we've got this high-powered growth engine. Now we need the brakes, the shocks, the airbag. We need the defensive assets that protect us not just from market storms, but honestly from ourselves.
And this 40% is put together very deliberately. That 30% in real estate, and we're talking about your own home here, is a kind of forced savings account. And with a low-interest mortgage, it's a fantastic hedge against inflation. It's a psychological sanctuary when the markets are going crazy. Then you've got the 10% in gold. Gold tends to do its own thing, it doesn't follow stocks. Think of it as your everything is on fire insurance. It's designed to shine when there's real panic in the air. And this is where that Morgan Housel quote just clicks into place, doesn't it? If you're being purely rational, a spreadsheet might tell you gold is a dumb investment. It doesn't pay dividends, it just sits there. But we aren't spreadsheets. We're emotional humans. And if owning that little bit of gold is the one thing that keeps you from panic selling all your stocks in a crash, then it's not just reasonable, it's one of the most valuable assets you own. It's the price you pay to stay in the game.
All right, let's move on to Section 4, and this might just be the most important part of the entire strategy's defensive core, the withdrawal fortress. Because building the wealth is only half the job. Making it last for decades of retirement through whatever life throws at you, that's the real challenge.
To really get what this fortress does, you first have to meet its number one enemy, sequence of returns risk. This is the boogeyman of retirement. It's the nightmare scenario where a huge market crash hits right when you start living off your money. Being forced to sell your stocks when they're down 30, 40, or 50% can permanently wreck your future. This entire withdrawal strategy is built to defeat that single risk.
So how do we fight it? With a 3-layered defense system. First, you start with an ultra-conservative 3% withdrawal rate. That gives you a huge margin of safety from day one. Then, if a market crash hits, say stocks are down 20%, you activate Layer 2, your 2-year cash buffer. You immediately stop selling anything from your portfolio and you just live off that cash. And that triggers Layer 3, the spending freeze, which means your portfolio withdrawal rate effectively drops to 0 during a crisis. The bottom line is, you are never, ever forced to sell your best assets at the worst possible time.
Okay, Section 5, Surviving the Stress Test. This all sounds great in theory, right? But how does this fortress actually perform when faced with some of history's worst financial disasters? Let's take a look.
And this is where you really see the beauty of the design. Take the lost decade from 2000 to 2010. Tech stocks were basically dead money, but what did great? Gold. Now, what about the stagflation of the 1970s? Stocks got absolutely hammered by inflation, but real estate and gold both acted as a fantastic hedge. You see how it works? When one part of the portfolio is struggling, the other parts are designed to kick in and protect the whole thing.
So, let's get to the final verdict. What's the trade-off here? Well, the pros are pretty obvious. You get an incredibly high margin of safety, it's built for real-world human psychology, and it's actually pretty simple to run. The cons? You're going to underperform in a screaming bull market. You won't be the person bragging about your returns at a party. That's the insurance premium you pay for peace of mind. And of course, you still have to be disciplined enough to rebalance, and always be mindful of that concentrated risk in your stocks.
And all of this really brings us to the final and most important question. This wasn't about finding the strategy with the absolute highest return. It was about exploring a strategy designed for maximum resilience. So the question you should ask yourself is this: is your plan built for a perfect world on a spreadsheet, or is it built to survive a real-world storm, and maybe more importantly, is it built to help you survive yourself when that storm finally hits?